In an era where trust in financial reporting is paramount, auditors play a pivotal role in ensuring the accuracy and integrity of financial statements. However, this task is not without its challenges, especially when it comes to identifying and addressing fraud risk. In this lecture, we will discuss the approach auditors use to identify risk and red flags that may indicate fraudulent activities. In an ever-evolving business landscape, the ability to conduct effective fraud risk assessments is not just a skill, but a necessity for auditors. Fraud is a deliberate and deceptive act involving dishonesty, misrepresentation, or concealment of information with the intent to gain an unfair or unlawful advantage, typically financial, at the expense of others. In accounting, fraudulent financial reporting is defined as any intentional, deceptive, or dishonest act that results in financial misrepresentation within the financial statements. It involves deliberately altering, fabricating, or concealing financial information to deceive stakeholders, such as investors, creditors, or regulatory authorities, for personal or organizational gain. Accounting fraud can take various forms, including misreporting revenue, inflating assets, or understating liabilities, with the goal of presenting a false financial picture of a company's performance and financial health. Imagine a scenario where a company's management is under pressure to meet earnings targets in order to secure a lucrative contract or maintain a high stock price. In this situation, they engage in fraudulent financial reporting to artificially inflate their financial results, making the company appear more profitable and financially stable than it actually is. As an example, management may engage in revenue recognition manipulation. Management might recognize revenue prematurely before it's actually earned by booking sales that have not occurred or shipping goods after the end of a reporting period, but recording them as sales in the current period. This inflates reported revenue. Another example would be where management releases excessive reserves set aside for bad debts or warranty claims, making it seem like they have fewer liabilities. This inflates net income and understates liabilities. Overall, these manipulations create a distorted picture of the company's financial health, potentially attracting investors, lenders, or customers who believe the company is performing better than it truly is. Eventually, when the fraud is discovered, it can lead to significant financial losses, legal consequences, and damages to the company's reputation. The second type of fraud is misappropriation of assets. In accounting, misappropriation of assets is defined as the theft or embezzlement of an organization's funds, assets, or resources by employees or individuals in a position of trust and authority. This fraudulent activity involves the unauthorized use, transfer, or conversion of a company's assets for personal gain or for the benefit of others without proper documentation or consent. Asset misappropriation can take various forms, such as employee theft, check tampering, fraudulent disbursements, and inventory theft. As an example, suppose a company employs a trusted accounting manager who handles the company's finances, including accounts payable. This manager decides to misappropriate company assets for personal gain through a scheme involving fraudulent disbursements. The accounting manager prints company checks with fictitious payees or alters the payee information on legitimate checks. They then deposit these checks into their personal bank account. Another method might be where the manager is issued a company credit card for legitimate business expenses. However, they begin using it for personal expenses such as vacations, shopping, and dining without authorization. In the above scenario, the accounting manager's actions constitute a misappropriation of company assets for personal gain. Such activities are typically illegal and can result in financial losses for the company. Detection and prevention measures, including effective internal controls and regular audits, are essential to mitigate the risk of asset misappropriation. Assessing the risk of fraud is a critical component of an auditor's responsibilities to ensure the integrity of financial statements. Auditing standards provide guidelines and procedures that auditors must follow when assessing the risk of fraud. It's essential for auditors to adhere to these standards diligently to ensure that they effectively identify and address fraud risks during the audit process, ultimately contributing to the credibility and reliability of financial statements. Additionally, they should maintain a proactive and skeptical approach to detect potential fraud and irregularities in financial reporting. Let's consider some of the key components of PCAOB Audit Standard 2401. AS 2401 requires auditors to assess the risk of material misstatement due to fraud at the financial statement and relevant assertion levels. This includes understanding the entity and its environment, assessing inherent and control risk, and identifying potential fraud risk factors. The standard emphasizes that auditors should presume that there is a risk of material misstatement due to fraud in the financial statements. This presumption guides auditors to consider the possibility of fraud throughout the audit process. AS 2401 also outlines procedures that auditors should perform to assess the risk of fraud, including evaluating fraud risk factors, considering the susceptibility of accounts and disclosures to fraud, and obtaining information from management and others within the organization. The standard provides guidance on how auditors should respond to identified fraud risks. This includes designing audit procedures specifically responsive to the assessed risk and considering the need for additional audit procedures. AS 2401 emphasizes the importance of communication and documentation. Auditors are required to communicate any identified fraud risks to appropriate levels of management and those charged with governance. Additionally, comprehensive documentation of fraud risk assessment process is essential. Auditors should evaluate the sufficiency and appropriateness of audit evidence, particularly concerning items that may be susceptible to fraud. The fraud risk factors identified by AS 2401 help auditors assess and respond to the risk of fraudulent financial reporting. These factors, often referred to as red flags, provide auditors with guidance on areas to scrutinize more closely. Some of the key fraud risk factors related to management characteristics and influence include those factors that exacerbate the risk of fraudulent activities. For example, ethical tone and integrity. A lack of ethical leadership or tolerance for unethical behavior can encourage fraudulent activities among employees who perceive a lack of consequences. Incompetent or inexperienced management may overlook or fail to address fraud risk factors, increasing the likelihood of fraud. A lack of commitment to internal controls, including management overriding controls for expediency, can create an environment conducive to fraud. If management discourages open communication or is secretive about financial matters, employees may hesitate to report fraud, allowing it to persist. Excessive financial incentives that prioritize short-term financial targets over long-term sustainability may encourage management to engage in fraudulent reporting to meet these goals. Previous instances of ethical lapses or regulatory violations within the organization may indicate a higher propensity for future fraudulent activities. A lack of independence or a board that is not vigilant in its oversight responsibilities may enable management to engage in fraudulent financial reporting with less scrutiny. It's important to note that these management characteristics can interact with various fraud risk factors, either amplifying or mitigating their impact. Effective corporate governance, a strong ethical culture, and proactive risk management practices are essential in reducing the overall risk of fraudulent financial reporting within an organization. Industry conditions can also influence the risk of fraudulent activities within organizations. Certain industry-specific factors can create opportunities and motivations for fraud. Some fraud risk factors include intense competition. Fierce competition can lead companies to engage in fraudulent activities to gain a competitive edge, such as overstating revenues or understating expenses to appear more profitable. Some companies operate in a complex regulatory environment. Companies with complex and evolving regulatory environments may face challenges in interpreting and complying with regulations, creating opportunities for unintentional errors or fraudulent misinterpretations. Companies with highly volatile market conditions or demand fluctuations may be more susceptible to fraudulent activities aimed at smoothing earnings or concealing losses during downturns. It's essential for organizations operating within specific industries to recognize and address these industry-specific fraud risk factors. Additionally, auditors should consider industry-specific risks when planning and conducting the financial statement audits. Certain operating characteristics and financial conditions can contribute to fraud risk. Some examples include ineffective internal controls. Weak internal controls such as inadequate segregation of duties or a lack of monitoring can create opportunities for fraud, especially when there is limited oversight. Another example is inadequate cash flow. A lack of sufficient operating cash flow may tempt organizations to manipulate financial statements to appear more financially stable to investors and creditors. When companies have limited access to capital, they may face pressure to maintain positive financial performance to attract investors or lenders, potentially leading to financial statement manipulation. Complex transactions or accounting estimates that require significant judgment increase fraud risk. A high degree of subjectivity in accounting policies, such as fair value measurements or revenue recognition, also increases fraud risk. Fraud risk is also increased by unusual or significant related party transactions that lack appropriate documentation or are not conducted at arm's length. Further, transactions with entities located in jurisdictions with weaker regulatory oversight can also lead to increased fraud risk. Finally, the use of significant accounting estimates, particularly when there is a lack of transparency in the assumptions or inputs used, can lead to higher fraud risk, as well as changes in accounting estimates that have a material impact on the financial statements. Overall, auditors are expected to consider these fraud risk factors in their risk assessment procedures. If auditors identify any of these factors or a combination of them during their audit, they should respond by performing additional audit procedures to address the heightened risk of fraudulent financial reporting. This may include additional substantive testing, corroborative evidence, or reassessment of the overall risk of material misstatement due to fraud. Employees can exhibit various red flags that may indicate potential fraudulent behavior within an organization. While these indicators alone do not necessarily prove fraud, they warrant closer scrutiny and investigation by management and internal controls. Some examples would be financial difficulties. Persistent financial problems, including late payments, foreclosures, or personal bankruptcies, may indicate an employee's financial distress and the temptation to commit fraud. Reluctance to take time off is another example. Employees who are consistently hesitant to take time off, especially those in positions involving financial responsibilities, may be trying to conceal fraudulent activities. A refusal to share duties or cross-training, an unwillingness to delegate or share duties with colleagues can be a red flag, as it may indicate an employee's desire to maintain sole control over certain processes. Excessive and unexplained overtime hours are also another example, especially for employees not typically required to work overtime. This may be a sign of fraudulent activities conducted outside of regular working hours. Refusal to cooperate with auditors. Employees who are uncooperative or defensive during internal or external audits and investigations may be attempting to hide fraudulent activities. Employees who exhibit secretive behavior, become defensive when questioned, or are evasive about their job duties and responsibilities also indicates potential fraudulent behavior. It's important to note that while these red flags can be indicative of potential fraudulent behavior, they do not prove guilt. If an organization observes these signs, it should follow established internal controls, conduct thorough investigations, and if necessary, involve law enforcement or forensic experts to determine whether fraud has occurred and take appropriate action. Maintaining a strong internal control environment, promoting ethical behavior, and encouraging a culture of reporting suspicious activities can help prevent fraud. The fraud triangle is a conceptual framework used to understand the factors that typically contribute to fraud in organizations. The fraud triangle consists of three key elements or conditions that, when present together, increase the likelihood of fraud. These three conditions are motivation. This condition represents the financial or emotional pressure faced by an individual that drives them to commit fraud. It could include personal financial difficulties, excessive debt, addiction, the desire for a lavish lifestyle, or other compelling reasons. Example would be an employee who is drowning in debt and facing imminent foreclosure on their home may feel pressured to commit fraud to alleviate their financial troubles. Opportunity. Opportunity refers to the circumstances or situations that provide an individual with the chance to commit fraud without getting caught. Weak internal controls, inadequate oversight, and access to assets or sensitive information are common elements that create opportunities for fraud. An example would be an employee in a position of trust and authority with unrestricted access to financial records and the ability to override internal controls can easily create fictitious transactions to embezzle funds. Rationalization. Rationalization is the psychological process by which an individual convinces themselves that their fraudulent actions are morally or ethically justified. They may rationalize the fraud by convincing themselves that they deserve the money, that they will pay it back, or that it's necessary to protect their job or family. An example would be an employee who rationalized theft from their employer by believing they are underpaid, and this act of embezzlement is just a way to balance the scales. Now let's look at each condition from the perspective of fraudulent financial reporting. Motivation. An example would be a CFO of a publicly traded company is under significant pressure to meet analyst earnings expectations to boost the company's stock price and protect their substantial stock options. They fear losing their job and a significant portion of their wealth if earnings fall short. This financial pressure motivates them to engage in fraudulent financial reporting such as inflating revenue or understating expenses to meet earnings targets and maintain the stock price. Opportunity. A controller with access to financial data and knowledge of weak internal controls at their organization seizes the opportunity to manipulate financial statements. They exploit the lack of segregation of duties and oversight by altering journal entries and misclassifying expenses to inflate profits. The organization's lax control environment provides the ideal opportunity for this fraudulent financial reporting. Rationalization. An executive in a struggling manufacturing company convinces themselves that overstating inventory values is necessary to keep the company afloat and protect the jobs of their loyal employees. They rationalize that the inflated financial statements are a temporary measure and that they will correct the figures once the company's financial situation improves. In their view, the fraudulent reporting is a necessary and justifiable act to save the business. The fraud triangle suggests that when these three conditions converge, pressure, opportunity, and rationalization, an individual is more likely to engage in fraudulent activities. It's important to note that while the fraud triangle explains the dynamics of fraud, it does not predict who will commit fraud. To prevent and detect fraud, organizations should focus on breaking at least one leg of the fraud triangle. This can involve creating a strong ethical culture, implementing robust internal controls, conducting regular audits, in order to reduce the motivation to commit fraud. Auditing standards provide auditors with guidance on how to respond to the risk of fraud in the audit of financial statements. This guidance is crucial for auditors to effectively address the risk of material misstatements due to fraud. As such, auditors should consider the risk factors that may indicate a higher likelihood of fraud, such as significant accounting estimates or a history of fraud within the organization. Auditors must also maintain professional skepticism throughout the audit, recognizing the possibility of management override of controls and the potential for fraud. The audit team should engage in a brainstorming session to discuss the potential for fraud, encouraging the sharing of insights and ideas regarding where and how fraud might occur. Auditors should specifically assess the risk of material misstatement due to fraud, irrespective of their assessment of inherent and control risks. They should make inquiries of management and others within the organization to obtain information about potential fraud risk. When auditors identify fraud risks, they must design audit procedures specifically responsive to those risks. These procedures may include a reassessment of the overall audit strategy, additional substantive testing, and obtaining corroborative evidence. Auditors must evaluate the sufficiency and appropriateness of audit evidence with particular attention to items that may be susceptible to fraud. This includes a critical review of the integrity of financial reporting and the reliability of audit evidence. The guidance provided by auditing standards is aimed at ensuring that auditors have a systematic and rigorous approach to addressing the risk of fraud during the audit. It promotes through risk assessment, proactive response measures, and effective communication, all of which contribute to the detection and prevention of fraud in financial statements. Auditors should be vigilant when examining financial statements, documents, and transactions for exceptions that could indicate errors, irregularities, or potential fraud. Exceptions are deviations from expected norms or patterns that warrant further investigation. Some examples include unusual revenue recognition patterns. A company consistently recognizes a significant portion of its revenue in the last few days of each reporting period. The significance of this pattern is that this could indicate potential earnings management or revenue manipulation. Another example would be inventory write-downs or reserves. If a company has a sudden substantial increase in inventory write-downs or reserves, it may signal an overstatement of inventory value or concerns about inventory obsolescence. Discrepancies and reconciliations. Frequent and unexplained discrepancies between the company's bank balances, for example, and recorded cash balances may suggest misappropriation of cash or poor cash management. If a company sees a substantial increase in the number of receivables that are past due or in the aging of accounts receivable, this could imply issues with credit quality, collectability, or aggressive revenue recognition. If the auditor notes that there is frequent turnover of employees responsible for financial reporting or internal controls, it may indicate dissatisfaction with the control environment or attempts to hide irregularities. If the auditor notes frequent discrepancies between supplier invoices and purchase orders or receiving reports, this could suggest unauthorized or fictitious purchases. Any unusual, complex, and unconventional executive compensation structures may seem disconnected from performance. This could suggest attempts to obscure excessive compensation or earnings manipulation. Auditors should also be mindful of altered supporting documents. Evidence of altered or forged supporting documents such as invoices, contracts, or expense reports may indicate potential fraud or manipulation of records. Auditors should also be aware of inconsistent expense patterns. An employee or department consistently reporting significant higher or lower expenses compared to their peers or historical data could imply or indicate unauthorized spending or expense manipulation. Auditors also look for significant unexplained transactions. Large unexplained transactions or entries that lack proper documentation would raise concerns or questions about the authenticity and legitimacy of these transactions. Overall, auditors should exercise professional skepticism when encountering exceptions and investigate them thoroughly to determine their root causes. These exceptions may signal errors, irregularities, or potential fraud that can impact the accuracy and reliability of financial statements. Auditing standards outline auditors' responsibilities for communication of fraud risk in the context of a financial statement audit. These responsibilities are essential to ensure that relevant parties are aware of the potential for fraud within an organization. The key aspects of auditors' responsibility for communicating fraud risk include communication with those charged with governance. Auditors are obligated to communicate with those charged with governance, for example, the board of directors or the audit committee, regarding the nature and significance of identified fraud risk. This communication includes discussing the auditor's assessment of fraud risk, the potential impact on the financial statements, and the auditor's planned response. If the auditor identifies or suspects fraud during the course of the audit, they have a duty to communicate it to the appropriate levels of management. This communication should occur as soon as auditors become aware of the fraud or have sufficient evidence to support their suspicion. The communication of fraud risk serves several purposes. It helps inform those charged with governance and management about potential vulnerabilities in the control environment, enabling them to take appropriate actions to mitigate fraud risk. Additionally, it ensures transparency in the audit process and helps guide the auditor's procedures to address the specific risk identified. It's important to note that while auditors have a responsibility to communicate fraud risk, their primary role is not to prevent or detect fraud. Rather, it is to provide an independent opinion on the fairness of financial statements. Detecting fraud is a byproduct of the audit process, and auditors are required to perform audit procedures designed to detect material misstatements due to fraud. The documentation of fraud matters is a critical aspect of the auditor's responsibilities during the audit of financial statements. It involves recording the auditor's understanding, assessment, and response to fraud risk and any identified instances of fraud. The objectives and requirements related to auditors' responsibilities for documenting fraud matters are outlined in the auditing standards. Documentation should capture the auditor's assessment of the risk of material misstatement due to fraud, including their identification of potential fraud risk and the evaluation of fraud risk factors. This helps ensure transparency in the audit process and provides a basis for planning audit procedures. Documentation should also include support for the auditor's judgment regarding the risk of fraud, the planned audit procedures in response to those risks, and the conclusions reached during the audit. It helps demonstrate that the audit was conducted in accordance with auditing standards. Proper documentation ensures effective communication within the audit team and with those charged with governance. It helps team members understand the nature and extent of work performed related to fraud risk and any fraud findings. Auditors must document their understanding of the entity's controls related to fraud, their assessment of the risk of material misstatement due to fraud, and the identified fraud risk factors. Documentation should include the auditor's response to the assessed fraud risk, such as the nature, timing, and extent of planned audit procedures. Documentation should also include the auditor's evaluation of audit evidence related to fraud, including its sufficiency and appropriateness. If the auditor concludes that fraud risks have not been adequately addressed or that there is insufficient evidence to support the absence of fraud, this should be documented. The work of engagement team members, including their assessment of fraud risks and the procedures performed, should be documented. Documentation should also include evidence of the supervisor's review of the work performed by the team members. Auditors must retain documentation related to fraud matters for a specific period as required by auditing standards or regulatory requirements. Proper documentation of fraud matters is essential not only for compliance with auditing standards, but also for demonstrating due diligence and professional care in the audit process. It provides a clear trail of the auditor's work, reasoning, and findings related to fraud, which can be essential in the event of disputes, legal proceedings, or regulatory inquiries.